do you think are 2 to 3 of the biggest mistakes people can make when investing or managing their money?
One of the comments that makes my skin crawl is when I hear people say something like, well, Warren Buffett became a billionaire picking individual stocks. I'll just do what Warren did. As if. There is a reason that Warren Buffett is famous, because Warren Buffett has managed to do something that is extraordinarily difficult to do. The ability to do it is extraordinarily rare. And the hubris to think, oh, I'll just go and do what Warren has done is, to me, stunning. It's just absolutely stunning. And the research indicates that while Warren has done it, as we talked about, you go out 30 years and less than 1% of people trying to do it who have survived that long have accomplished it. The second thing is trying to time the market. And you can't turn on the financial news or open up a financial periodical without finding somebody who's telling you definitively where the stock market is going next. Nobody knows. If you could accurately do that with any consistency, you'd be far richer than Warren Buffett and far more lionized. It would be magic dust. Nobody can tell you where the market is going. You just can't predict the market, and trying to is a fool's game. To me personally, what wealth represents is security and freedom. So security to protect you from what the world can throw at you, and freedom to chart your own path in a way that you couldn't do without the resource. On the financial point of view, I suppose if you have enough assets that 4% of that amount can cover your annual expenses, you can consider yourself financially independent. So you can work at it from two different directions. You could say, well, I have $1 million, so 4% of that is $40,000. Can I live on $40,000 a year or not? And therein lies the answer to your question. Or you can look at it from the other direction. You can say, I need $40,000 to live on, so how much do I need to be financially independent? You multiply 40,000 by, as it happens, 25, you get $1 million, and there's your answer. So it really depends on what your needs are. The reason that I prefer keeping it simple is simply more powerful. Simple is what gets you the best results. And in this case, when I talk about simplicity, I'm talking about index funds and specifically broad-based stock and then bond index funds when you bring them into it. There are a lot of reasons that simplicity is an advantage. It keeps your costs low. It keeps your life simpler. It makes things, when the time comes, easier on your heirs. But the most important thing is it is the most powerful way to reach financial independence. And so when you have a simple path, you can just get a couple of things right. You'll have a very powerful performance. You will outperform the vast majority of professionals out there. There is a large industry, Wall Street, whose drumbeat is counter to our best interests, and that is based on making this as complex as possible, putting out a siren song that you too can be Warren Buffett. You too can pick stocks. You too can outperform the indexes, only if you're willing to pay us for the privilege. And that's a very seductive message, because everybody wants to think that they can be above average and outperform. The irony is, if you invest in index funds, and of course the slam that active managers put against index investing is that you will only get average returns. That's a little bit misleading, because yes, the index gives you the return of the market overall, but that return is far above average. Index investing, based on the research that has been done, outperforms, depending on what numbers you look at, 80 to 85% of active managers over a 15-year period of time. If you research out 30 years, the number of active managers who can outperform the index is less than 1%. That's statistically zero. And indexing, which was first put in front of me in 1985 by a good friend of mine, there's something about it that is very counterintuitive. And I think particularly for smart people like the people in this room and the people listening, because you look at it and you say, well, indexing says I buy every stock in the index. And yet, if I can only just not buy the obvious dogs, I'll outperform. I mean, outperforming seems like it should be so simple. But the problem with that, or even if I just buy the top performers, and not even by the mediocre or the low performing ones. Obviously I'm going to outperform. And yet you look at that research that says that doesn't happen. And of course, the reason it doesn't happen is today's dogs are sometimes tomorrow's great turnaround success stories. And those that are flying high are the stories of how they crash and burn. So there is no way to know what is going to happen with specific stocks. And it is just way too easy to guess wrong. Homeownership is the American religion. And you could go to Daily Plaza in downtown Chicago, and you could set up your little soapbox, and you could climb up on it and pick any major religious leader and begin to vilify that individual, Jesus Christ, Muhammad, Buddha, whoever, just vilify them in the most horrific terms possible, and people would just turn around and walk away. I mean, they'd ignore you. You get up on that same box and suggest that homeownership isn't the perfect thing for everybody to do, and they start gathering rocks. And I, by the way, am not anti-homeownership. I've owned homes most of my life. I am anti-believing the propaganda that it is always or even commonly a good financial decision. It can be a great lifestyle decision, and that's why I bought the houses I bought over the years. But I never once bought them thinking I was doing something that was financially astute. Because unless you happen to get lucky with a rising market, and that does happen, it's generally not the best thing you can do with your money if financial independence is your goal. You are not making an investment. You're making a lifestyle decision. All of our decisions don't have to be driven by financial considerations, but you should always understand the financial dynamic of what you're choosing to do. And I have a post about buy versus rent, run the numbers, which talks you through how to do that. So I would suggest if you're renting now and you're thinking of going into a house or a condo, that you first run the numbers and find out exactly what it's going to mean financially. And it might be that it's going to be less expensive than when you're renting. That's possible. That does happen. More commonly, you're going to find that it's going to be more expensive. But then you know, and just because it's more expensive doesn't mean that you don't have to buy the house. It just means that you understand what you're paying for the lifestyle decision that you're making. If you have a visual image, let's say, of a long banquet table that is just groaning under the weight of every kind of food and preparation and dish you can possibly imagine, think of that image as what the financial community has laid out for us and that they want us to partake in. The problem is these are all very expensive things that are for the most part designed for the people who have created them and who sell them to enrich them, not necessarily what's best for us. That's the bad news. The good news is you can put your arm down on that table at one end, except for a tiny little corner, and sweep it all onto the floor, because none of that matters. Only a very small sliver of what out there really matters for us in building our wealth. That's index funds, and that's very specifically broad-based stock index funds and broad-based bond index funds. If you're really starting from ground zero and you really do not have any base of knowledge on this, and that's not a bad thing, that can be an advantage, because at least it means you don't have bad knowledge, and there's a lot of bad information out there. So if you're at that ground zero level, don't feel bad about it. That's an advantage, and there's nothing you have to unlearn. So a 401k is not an investment. An IRA is not an investment. A TSP plan is not an investment. Those are buckets. In those buckets, you hold your investments. Investments are things like mutual funds and stocks and bonds. So those are the investments that you choose to put in your bucket. In 2007, 2008, 2009, when the economy cratered, Wall Street was selling products they didn't understand. So if this stuff looks complex to you, it's because this stuff is complex, and in some cases intentionally complex. But we don't care about that because we don't need any of that. And once you understand that you don't need that complex stuff, then doing it yourself becomes much more attainable, even if you don't have any interest in financial stuff. Like, frankly, my daughter, she has better things to do with her life than fool around with this financial stuff that intrigues her dad. And that's great. I mean, people have bridges to build, ways to make the world work. The beauty of this is that if you get a couple of things right financially, you can profoundly change your financial life without having to dwell on it. And you can get on with doing things that are more important to you and maybe more important to the world. Fidelity Investments did a little piece of research, I think about a year and a half ago, and they were curious as to what group of investors in their funds did best. Because the research indicates that the people who invest in a mutual fund outperform, or underperform rather, the performance of that fund. And you say, well, how's that possible? If they're investing in the fund, their performance should match the fund. The reason they underperform is they try to dance in and out. They try to time the market. So when Fidelity did this research, they determined that one group of investors did significantly better than any other group who owned their funds, and that was dead people. The second best performing group were people who forgot that they owned the fund. So you can't time the market, and especially when the market has been on as long a bull run as it has, the media is filled with people telling you that they know what it's going to do next. Dollar cost averaging is the idea of putting in a little bit of money at a time over a period of time. The problem with that is that unless the market conveniently goes down while you're doing it, you will have been giving up gains rather than avoiding losses. And the thing that really bothers me about it is at the end of your investment period, where you've finally deployed all of your money, who's to say the next day isn't the day the market takes its big plunge? So you have $120,000 you want to deploy, and you say, I'm going to do it over the next 12 months, and I'm going to put $10,000 a month in, and I'm going to avoid that risk. You're not avoiding the risk. You're just delaying the risk until you put that final $10,000 in. Now, if you get lucky and the market plunges, you'll pat yourself on the back. But understand that's only luck, because nobody knows where the market is going. There's a saying that the best time to have invested was yesterday, and the second best time is today.